All right, let's get right into this explainer and unravel the grand illusion behind what is, without a doubt, the most notorious financial crime in history. Today, we're taking a structured, step-by-step look at a story that completely shook the global financial system to its core. We're talking about the fall of Bernie Madoff. And really, our central theme today is survival. I mean, how exactly does a massive lie maintain its shape under the absolute crushing pressure of the modern financial world?
30 years. I just want you to let that sink in for a second. 30 years. This wasn't some quick, fly-by-night scam that operated in the shadows for a few months before skipping town. A 3-decade run means this operation actually survived the Black Monday crash of 1987, it survived the dot-com bubble bursting in the early 2000s, it outlasted multiple shifts in presidential administrations and totally different regulatory environments. We're talking about a completely fabricated financial empire that somehow persisted through 30 years of audits, wild market volatility, and massive global changes.
So that naturally brings us to the literally $64.8 billion question we're going to deconstruct today. How did the biggest financial illusion in history survive right in plain sight? Because make no mistake, it was in plain sight. Madoff wasn't hiding out in some remote offshore bunker. He was operating right in the beating heart of Manhattan, literally rubbing shoulders with the world's most sophisticated investors, top regulators, and financial experts. To truly wrap our heads around how this happened, we have to look at the incredibly stark dual reality he constructed. Section 1. The Grand Illusion. The Man Behind the Curtain. We really have to start with the architect himself. Madoff's public persona was practically flawless. The guy was an actual pioneer of electronic trading. He was the chairman of the NASDAQ. He carried this absolute authority and undeniable prestige. But then, you contrast that with his private reality. It is completely wild. Literally 2 floors below his legitimate high-tech trading business on the 19th floor of Manhattan's Lipstick Building sat a secret, heavily guarded room on the 17th floor. There were no cutting-edge, high-speed trading algorithms down there. Nope, it was just employees manually printing out totally fake trading statements on outdated, clunky computers. The gap between the glossy 19th floor and the primitive 17th floor is just staggering. Section 2. Anatomy of a Ponzi. The mechanics. Look, to understand the actual machinery of this crime, we need to strip away all the intimidating Wall Street jargon. A Ponzi scheme is, at its core, incredibly simple. It's an investment scam that pays early investors with funds taken from later investors, instead of from actual generated profit. That's it. There was no secret, high-tech trading happening with the victim's money. Literally none. Madoff wasn't beating the market. He wasn't even playing in the market. It was just a highly organized, massive-scale system of robbing Peter to pay Paul. When you strip away all the marble lobbies and the prestige of Wall Street, the fundamental math is absolutely no different than a cheap street corner hustle. It was just executed with billions of dollars. Here is the actual plumbing of how the money moved behind the scenes to keep the lights on and the illusion glowing. It was a very basic 3-step cycle. Step 1, Madoff takes cash from a brand new investor. Step 2, instead of actually buying stocks, that cash gets deposited straight into a regular, everyday checking account, while his team prints out fake statements to show fictitious portfolio growth. Step 3, when an older investor decides they want to cash out some of their profits, Madoff simply withdraws the new investor's cash to pay them. As long as more fresh cash is walking in the front door than is walking out, the cycle can theoretically continue forever. Section 3, the decades of deception, the blind eye. Now, understanding those basic mechanics is only half the battle. How exactly do you keep a lie like that alive for 3 decades under the magnifying glass of intense financial scrutiny? Well, it evolved. In the 1980s, Madoff cultivated an air of deep, intense exclusivity. It was like a velvet rope club. You couldn't just walk in and invest, you had to be invited. This brilliant psychological trick made people absolutely desperate to hand him their money. Moving into the 1990s, he delivered suspiciously consistent fake returns. While the rest of the market was a volatile roller coaster, Madoff's line basically went straight up at a steady 10 to 12%. It was mathematically impossible, yet investors loved getting rich too much to ever really question it. Then, going into the 2000s, the strategy shifted to straight-up evading regulatory red flags. There were whistleblowers, like financial analyst Harry Markopolos, who actually did the math and literally handed it to the SEC. But incredibly, regulators failed to look closely enough to realize the trades simply did not exist. Basically, these three elements acted like an impenetrable force field around Madoff's secret 17th floor. First, the extreme exclusivity meant victims felt privileged just to be there, so they didn't dare ask tough questions and risk getting kicked out. Second, the consistently impossible returns meant that, on paper, everyone felt like they were getting incredibly wealthy. Who wants to ruin the party by digging deeper, right? And third, the complete failure of regulatory oversight provided this ultimate stamp of approval. I mean, if the authorities have investigated and said everything is fine, why on earth would an ordinary investor doubt it? These three pillars worked in perfect, horrifying harmony to keep the whole charade going.
Section 4. The 2008 breaking point, the catalyst.
But eventually, reality bites. Global events finally pierced the illusion. The 2008 financial crisis was essentially the massive, jagged pin that popped the 30-year balloon. And this is crucial. Madoff's scheme didn't collapse because some hotshot regulator finally caught him or because he suddenly grew a conscience. Not at all. It collapsed because the macroeconomic environment of the entire planet practically broke down. When the global markets crashed in the fall of 2008, pure panic set in. Huge institutional investors and wealthy individuals suddenly needed massive amounts of cash to cover their burning losses elsewhere. So, all at once, everybody wanted their money back from Bernie.
The math here is just brutal. Madoff was suddenly staring down the barrel of an unprecedented surge of withdrawal requests. We're talking roughly $7 billion, with a B, being demanded by panicked investors in a matter of weeks. But remember how the scheme works? Because the global economy was in absolute freefall, nobody, and I mean nobody, was handing out new investment money. The lifeblood of the entire Ponzi scheme had dried up overnight. You had an immense tidal wave of demand going out and absolutely zero fresh cash coming in to satisfy it.
Section 5. The House of Cards, the inevitable collapse. Ponzi schemes are basically like sharks. If they stop swimming forward, they die instantly. There is no gradual winding down. Facing roughly $7 billion in withdrawal demands and sitting on only a tiny fraction of that in his bank account, the math had finally caught him. With his back completely against the wall, Madoff sat his sons down and confessed that his entire asset management arm was, quote, one big lie. His own sons turned him in the very next day. It led to his immediate arrest and triggered a devastating financial freefall that vaporized billions in paper wealth in a literal instant. Bringing all the threads of this explainer together, this single, staggering fact remains the most chilling takeaway from the entire saga. The world's biggest Ponzi scheme survived for 30 years. Ultimately, this wasn't just a failure of one man's broken morality. It was a massive, systemic failure of human psychology, of institutional financial oversight, and of the most basic principle we have: trust, but verify. The sheer duration of this crime really forces us to take a hard look at the systems and the people we place our blind faith in every single day. So, when financial illusions can look absolutely flawlessly perfect, what is the true cost of blind trust? In a world where credibility can literally be manufactured and millions of dollars on a screen can turn out to be nothing more than pixels, a healthy dose of skepticism isn't just a good idea. It is absolutely essential for survival. I really want to leave you with that thought to chew on the next time you encounter an opportunity, a person, or an investment that seems just a little bit too good to be true. Thanks so much for joining me for this explainer, and remember, keep asking the right questions.